I'm looking at the futures right now. That's why I was glancing at my phone, and it's shocking. You have silver futures at $47.30, up fairly significantly today, and gold futures up $50 to $38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Then again, I mean, it's moving at a clip that just seems to be defying gravity. And now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. You know, we talked about the chief investment officer of Morgan Stanley shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills, those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought them. Prudential is who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take, yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting, Michael Oliver talking about metal. Michael is a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200, and he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system, because in my mind, as much trouble as China is having, their yuan gets saved by gold, and the dollar without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia, you'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually, it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this.
I was looking at the futures market earlier today. That's why I kept glancing at my phone. And I'll tell you what, I had to double check that the numbers weren't typos. Silver futures sitting at $47.30, up sharply again, and gold up another $50 to $3,858 an ounce. These are the kind of moves that make even a guy like me, who's seen plenty of bull markets, sit back and say, all right, something big is happening here. Because what we're witnessing right now is not just another speculative push, it's a full-blown reallocation of capital on a global scale. And what's so fascinating is that it's happening almost quietly. You're not seeing CNBC screaming about it 24/7. The average American still has no clue. They're too busy chasing tech stocks or arguing politics. But behind the curtain, the biggest money in the world is shifting. And it's shifting into the oldest, most reliable asset known to man, gold and silver. Now, when I look at these moves, it doesn't feel like random volatility. It feels like gravity finally catching up with fundamentals. For over a decade, we've lived in a world of suppressed rates, artificial liquidity, and paper manipulation that kept metals in a straitjacket. But now the paper world and the physical world are colliding. And when that happens, the truth wins. I've been in this business long enough to know the difference between hype and structural change. This is structural. The same bankers who used to sneer at gold are now issuing notes to their private clients saying, hey, maybe we should add some exposure. Take Morgan Stanley. Their chief investment officer just broke one of the biggest taboos in modern finance. He abandoned the sacred 60-40 portfolio model. For decades, it was gospel. 60% stocks, 40% bonds. It was supposed to balance growth and safety. But in a world where both stocks and bonds are losing value in real terms, that model's a dinosaur. So what's the new model? 60-20-20. 60% equities, 20% bonds, 20% gold. Think about that. Wall Street, for the first time in my 35-year career, is telling its clients to hold a fifth of their wealth in gold. And it's not just Morgan Stanley. Bank of America came out with something even bolder. Michael Hartnett, their chief strategist, proposed a 25-25-25-25 model. Stocks, bonds, T-bills, and gold. And here's the kicker. His model is up 16% year-to-date versus just 10% for the traditional 60-40. Meanwhile, gold itself is up almost 50% this year. You can almost hear the analysts who mock gold for a decade choking on their words. This is what happens when truth reasserts itself, when math meets reality. You've also got Chris Wood, the global head of equity strategy at Jefferies, talking about gold going to $6,600. Think about that number for a second. That's not some guy on YouTube in his basement making predictions. That's the head of a global equity desk that advises institutional clients, pension funds, sovereign funds, endowments. These are people who move billions, not thousands. So ask yourself, what do they see? They see what I see, that the entire financial system has been stretched to its limits, that we're now in a debt spiral where interest expense alone is consuming the US budget, that the dollar's dominance, which we all took for granted, is being chipped away by countries building an alternative trade settlement network, one that doesn't rely on trust in Washington. And they see something else too, momentum. Michael Oliver, one of the sharpest technical minds out there, you've probably seen him on this channel, said recently that the lid's coming off. His momentum indicators are flashing something we haven't seen in decades. He's talking about silver potentially gushing to $100, maybe even $200 over the next several months into Q1. Gold, he says, has broken out of a 12-year-old uptrend channel, and this month could close at a new all-time peak on annual momentum. Those aren't empty words. He's been right before. But even if you're not a chart guy, you can feel it. There's a hum in the air. You've got Gundlach, Jeffrey Gundlach, the bond king, saying it's time to abandon the 60-40 split and move toward hard assets. That's like the casino owner walking onto the floor and telling the gamblers, maybe stop playing the house game. When the people who are the system start warning against it, you pay attention. He's calling for $4,000 gold by year-end. And if you think that's crazy, remember, we're already near $3,900. The mainstream narrative is still in denial. They'll tell you, oh, it's just inflation hedge buying, or oh, it's geopolitical. This isn't a trade. This is a rotation from paper promises to tangible wealth.
Can you touch on the retail bullion phenomenon that you're seeing both in terms of demand, supply, physical availability, and premiums?
Yeah, demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which is, I'm not happy with it right now. It's gotten so low, so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand, and maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and Bank of America. These people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets, really doing or set up to do as well if things continue as the insiders are selling and the public is all in. It's something that concerns me, honestly. And you know, you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, I mean, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, you know, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, that's going to change. And now all of a sudden supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, you know, putting the seed out there that hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight.
When I tell you that the market feels different this time, I mean it from the core of my experience. This isn't the same as 2011 when gold peaked at $1,920 and the paper traders walked away thinking they'd conquered it. That was speculation on leverage. This is migration. Generational capital shifting out of a dying fiat system into something real. And I know some people still think, oh, Andy, you've been talking about this for years. Yeah, I have. But for the first time, the people who used to laugh are now calling me quietly, asking how to buy metal off exchange. They don't want ETFs, they don't want futures, they want physical, bars, coins, in their hands or in trusted vaults. Because here's the truth no one at CNBC wants to say out loud. The physical market is the real market, and right now it's flashing red hot. Retail demand is surging. It's not panic yet, but it's starting to feel like that kind of tension that precedes an earthquake. Our phone lines at Miles Franklin have been lighting up in a way that reminds me of March 2020, when COVID panic broke out. Except this time, it's not fear of a virus. It's fear of a collapsing currency. And the supply side? It's tightening by the day. For most of this year, supply was decent. Distributors were sitting on inventory. Premiums had come down. Things were calm. But calm breeds complacency. Dealers stopped reordering aggressively because carrying inventory got expensive. The cost of financing millions in product went through the roof. Shipping and insurance costs exploded. The U.S. Mint, already a model of bureaucratic inefficiency, kept falling behind on Silver Eagle production. Then just like that, snap, the tide turned. The big money started moving. The insiders, the same CIOs and fund managers we just talked about, began allocating, not to ETFs, to physical, to storage programs, to central bank contracts, and within weeks, premiums started rising. Supply chains that were flush 6 months ago are now thin. Product availability is shrinking fast, not just for silver, but even for gold kilo bars. This is exactly what I've been warning about for years. The transition from plenty to panic happens overnight. It's not just us dealers feeling it. The primary distributors, the big boys who buy directly from mints, are calling around, asking what inventory is left. And that's how you know the tide is turning. Because when they start looking, you're already late. People forget, this is a small industry. In terms of annual market size, all the physical silver and gold available for retail purchase globally wouldn't even fill 1 year of U.S. defense spending. It's a thin, fragile supply chain. Now imagine what happens if allocation to gold just reverts to the historical mean. Rick Rule said it best. Right now, only 0.5% of total U.S. investment assets are allocated to precious metals or mining equities. The 4-decade mean is around 2%. If we merely revert to that average, that's a 4-fold increase in demand. But what if, and I'm saying this because it's now on the table, what if we move to 5% or even 10%? Do the math. The system doesn't survive that level of demand without breaking, and now you've got these major institutions talking about 20% or 25% allocations. Let me put this into perspective. If the world's pension funds, mutual funds, and insurance portfolios shifted even 2% of their holdings into physical gold, you'd drain every ounce of deliverable inventory on Earth. A 20% allocation would be apocalyptic, not for gold owners, but for anyone trying to buy. You'd have what I call a bid-only market. That's when there's no ask price because nobody's willing to sell. And this isn't some distant scenario. We're inching closer every week. Look at what's happening in the wholesale markets. Central banks are pulling more metal off the market than ever before. In 2023, central bank gold buying hit its highest level in modern history. That wasn't retail buying coins on eBay. That was sovereign wealth reallocating from US treasuries into tangible reserves. And where is that gold going? East, to China, to India, to Singapore, to the Middle East. China alone has imported thousands of tons, far more than they admit officially. They're not doing it for fun. They're preparing for the next monetary architecture. Think about what that means. When you see countries like China and Russia building interconnected gold vaults across the global south, Hong Kong, Shanghai, Riyadh, Singapore, Dubai, St. Petersburg, that's not coincidence. That's infrastructure. It's the framework for a parallel settlement system. A system that doesn't rely on trust in the US or the UK, a system that says we will trade in gold-backed instruments stored in our own vaults outside the Western banking system. And here's the part that blows my mind. Most Americans have no idea it's happening. They're too busy chasing AI stocks or watching the Fed's rate forecasts. Meanwhile, the global financial architecture is being rewritten in real time. Every vault that opens in Asia is a vote of no confidence in the dollar. Every ton of gold withdrawn from the LBMA or COMEX and moved east is another brick in the wall of a new financial order. And when it's finished, when enough countries say, we don't need the dollar anymore, that's when everything changes. People ask me, Andy, are you saying the dollar's going to collapse? No, not collapse like a car crash. It'll erode like rust, slowly at first, then all at once. The dollar won't go to zero. It'll just buy half as much, then a quarter, then less. That's how every fiat currency ends, through quiet theft, not loud explosions. And gold doesn't need to replace the dollar to win. It just needs to outlast it. That's exactly what it's doing right now. Gold has outperformed every major currency this year. Not just the dollar, the euro, yen, pound, you name it. So while the talking heads argue about inflation being under control, the real story is that purchasing power across all G7 currencies is collapsing, and the average investor still asleep. When they finally wake up, when they realize that the money in their savings account is guaranteed to lose 4 to 8% per year in real terms, the stampede begins, and I promise you there won't be enough metal to go around.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.